Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Okay, what we have to learn today is for financial management. This is week 2. So today we will cover for topics management of current asset. Okay, today we will cover for management of current asset. Okay, what we will cover or what the learning outcome for this topic. Okay, we have 5 learning outcome. The first one is at the end of this lesson, all of students should be able to explain the working capital and its terminology, and also working capital policy. Okay. The second one, describe motive of holding cash. Okay. The third one is identify inventory management costs. The fourth one, describe the account receivable. Okay, describe the account receivable management tools. And the last one, describe different types between the short-term borrowings. Okay, so let's start. Okay, so what is actually working capital? Okay, as accounting student, DIA student already know what is actually working capital. Okay, if you still remember in financial accounting 1, financial accounting 2, financial accounting 3 and 4 itself, okay, we learn already about working capital. Okay, what is actually working capital? Okay, in accounting, working capital is actually current asset divided by current liabilities. But in finance, in financial management, what is working capital? Your working capital assesses a company's ability to pay its current liability with its current asset, indicating the company's short-term financial health and operational efficiency. Okay, that is working capital in financial management definition. Okay, assess the company's ability to pay its current liability with current asset. Okay, to measure the ability of company of business pay its short-term obligation. This is working capital. Okay. So net working capital is defined as the differences between the company current asset and current liability. Okay, the differences between current asset and current liability means that net working capitals compute, okay, by current asset minus current liability. A positive net working capital tells us that the company is able to pay its current liability and reduce the risk of insolvency. Okay, the positive working capital tells us that that company or that businesses have a positive working capital, means that they are able to pay its short-term obligation. Okay, and also reduce their risk of insolvency. Okay, net operating working capital measure company ability to pay of all working liability with its operational asset. This is an important metric because it shows the leverage of the company and the amount of current working asset. Okay, this is operating. Operating working capital means the ability of the company or the businesses to pay its operational costs using current asset. Okay. How about the working capital management? Okay, working capital management refers to set activities performed by a company or businesses to make sure it good enough resources day-to-day operation expenses while keeping resources invested in productive way. So this is a working capital management. Okay, so refer the set activity, how that businesses set the activities of business or set the activities of the company to make sure that company have enough resources to run the day-to-day or daily operation of that businesses. Okay, next. Okay, why the importance of working capital management? Why that is important? Okay, to manage working capital, because we want to improve credit profile and solvency. Okay, we want to improve credit profile and solvency. Okay, increase the business value. Okay, we want to increase the business value, okay, because of when we have enough current asset to cover all the current liability, and also to run the daily business operation is very good lah for company. So that will increase the business value. And favorable financing condition. Okay, working capital, positive working capital, net working capital means that they are very good in financing condition. Okay, and also positive working capital will give a competitive advantage for that company. All right. Okay, next, what is actually two types of current asset for accounting subject. For accounting student, okay, before that we already knows the category of asset is actually divided into two category: current asset and non-current asset. In financial management, we go deep the types of current asset. Okay, actually current asset also divided into two category. Okay, we have a permanent current asset and temporary current asset. Okay, what the differences between these two items? Okay, let's look the definition. Okay, permanent current asset. What is permanent current asset? The minimum level of current asset. Okay, look at the notes at the bottom of the slide. Okay, permanent current asset is the minimum level of current asset which the company needs to operate. Okay, this is permanent current asset. The company can operate without any current assets such as cash, inventory, and other current assets. Okay, they require cash to pay any payment to supplier. Without cash, the company will face liquidating. That is a major cause of bankruptcy. For that trading company, they must maintain the inventory in the warehouse and it needs to be ready for the customer. So this is the permanent current asset. They need to have a minimum level of current asset, minimum level of cash, minimum level of cash in hand, cash at bank, minimum level of inventory to make sure that all the product will be ready for the customer. Okay, so that we need to have enough inventory in our warehouse. This is permanent current asset. How about the temporary current asset? Okay, temporary current asset are the current asset that fluctuate over time. Okay, fluctuate over time. For example, in season only, for certain season only, and expected to consume or sell within a year. The decrease the current asset will not impact business operation. They may change due to business activity. For example, season of um, Hari Raya. Okay, Hari Raya season. Okay, for example, Hari Raya Aidilfitri, that uh, all the businesses related to apa ni, to Kuih Raya, for example. Okay, so that Kuih Raya is actually the temporary current asset. Okay, why Kuih Raya is temporary current asset? Only the businesses will sell the Kuih Raya in the season of Hari Raya. That is temporary current asset. Only temporary for that season only. Okay. Another example is, for example, for in school holiday, okay, before starting the new year of school year, okay, so you can see all the supplier of apa ni, of the uniform of school will display all the stock, all the inventory of the uniform. Okay, then all the parents will purchase of that of that uniform for the kids. Okay, this is considered also see a temporary current asset. Okay. Okay, next. This is a very important part also. This is working capital policy. Okay, we have 3 working capital policy of that company or businesses. Okay, the first one is restricted, the second one is relaxed, and the third one is moderate. Okay, restricted working capital policy means, okay, the estimation of current asset for achieving target revenue is done very aggressively without considering for any contingency and provision for any unforeseen event. After deciding, these policies are forcefully implemented in the organization without tolerating any deviation. Okay, restricted means that they have a certain current asset that that company need to achieve, or the certain revenue or targeted revenue that this company, that the businesses need to achieve. Okay, the level of current asset that the company set to achieve. Okay, this is the restricted policy. Okay, uh, the actually working capital policy is actually the refer of total level of investment in current asset. Okay, for attaining their targeted sales. So for restricted, they have the targeted level of current asset. Okay, because they want to achieve that income target or sales target. Okay, for relax, how about the relax policy? We go to the relax first. Okay, the relax first. Okay, the relax policy, the relax working capital policy, the estimation of current asset for achieving the target revenue is prepared after careful consideration of uncertain event. Okay, after careful consideration of uncertain events such as seasonal fluctuation, sudden change in the level of activity of sale. Okay, after the reasonable estimated, also a cushion to avoid any unforeseen circumstances is left to avoid the maximum possible risk. Okay, the difference between the restrict and relax, the relax is consider uncertain event, uncertain happen or sudden changes in the economic, say for example now COVID-19. Okay, so some of the businesses cannot run their business. Okay, so relaxed policy is consider all of that things, but restricted policy is not considered. Okay, this is very aggressive. Okay, no matter what is happening in the industry, what happened in the country, so we need to get this level of current asset. That's restrict. Okay, different between difference to the relaxed, more relaxed, then they consider circumstances, any circumstances. Okay, moderate policy is between, balance into policy, not too restricted and not too relaxed. Okay, in between, jadi dekat tengah-tengah lah, intermediate. Alright. So next, okay, now a cash management cycle. Okay, what is the cash management cycle? Okay, this is actually cash conversion cycle, CCC. Okay, what is the CCC? Okay, cash conversion cycle means that from we receive from customer, okay, and how long that we take cash in and cash out in the businesses. Okay, cash in means we receive from the customer, cash out we pay to the accounts payable. So that is actually cash conversion cycle. So this is the formula of cash conversion cycle. Okay, cash conversion cycle equal to inventory conversion period plus debtors collection period plus payable deferrable period. Okay, so actually what is cash conversion cycle is the length time between the payment of creditors and receipt of the cash from debtors. How long the time, okay, the time taken between we receive cash from the all account receivable or from the debtors and the payment that we make to the supplier. The length time between that cash in and cash out. Okay, right? Okay. So actually the shorter time taken for cash conversion cycle is better. Okay. Okay, now why we need to holding cash? Okay, why we need to holding cash? Reason for holding cash. Okay, remember that our topic is cash current management of current asset. Okay, okay, how to manage the current asset? So this is the first current asset that we need to manage. Okay, which is cash. So now how we need to manage the cash? Okay, because of these three reasons. Okay, the first one is for transaction motive. Okay, transaction motive because we need cash to make everyday payments, to make everyday transaction. Okay, this will the maintenance of cash for the purpose of meeting cash needs that rise during the ordinary course of the business of firm. Okay, we need cash. Okay, when you want to sell something, Okay, when I want to buy something, we need cash for that transaction. In the daily business operation, we need cash. Okay, that's the reason for holding cash. The second one is precautionary balance. Okay, the need to have cash on hand to meet unexpected needs or unforeseen expenses. Okay, in other words, it is maintenance of cash balance as a buffer against unexpected needs for cash disbursement that may rise. Okay. This is for unforeseen expenses, unexpected needs. For example, for the pandemic, COVID-19 now, okay, for 2 years, okay, prolonged to 2 years, okay, we need, this is unexpected needs. Maybe we still need to pay the rental expenses. We need to still pay all the obligation of the businesses, okay. We still need to pay the salary of our workers, okay, our staff. Okay, so that's a precautionary balance. Okay, speculative. Okay, what is speculative? This is based on the desire to take advantage of potential profit-making opportunities that require cash. This is known as a speculative short-term investing and accounts for small percentage. The firm cash holding. This is for speculative one. Okay, maybe we want to take a certain advantage for the investment. Okay, so we invest. For investment, we need that cash lah to invest. Okay, for take advantage for potential profit for that investment. So we need that cash to invest. So this is for speculative motive. Right. For next, okay, the second one for management of current asset is manage inventory. How we manage inventory? Okay, how to manage inventory? Okay, how to manage inventory is the first one is what is actually the definition of inventory. Inventory management ensure the firms have sufficient inventory for the production and for sale to customer. Okay, we need enough inventory to make sure we can produce the product and we can sell to our customer. Okay, this is inventory management. Okay, so this is the economic order of quantity, EOQ. What is EOQ? EOQ model determines the order size that minimize total inventory cost. So this is a model that we can follow, that we can apply in order to minimize our total inventory cost. Okay. Okay, EOQ is a company optimal order quantity that's minimized its total cost related to ordering, receiving, and holding inventory. This formula is best applied in situation where demand, ordering, and holding costs remain constant over time. Okay, so this is the technique that we can apply in our business to minimize our total cost relating to ordering, receiving, and holding inventory. Right? This formula is best applied when all the demand, ordering, and holding costs remain constant over time. This is the assumption that we have to assume. Okay. What is holding cost? They say holding cost, ordering cost, you already learn in cost accounting subject, right? So this is the refresh one. You have to refresh your knowledge in the costing or management accounting, if I'm not mistaken. What is the holding cost and ordering cost? Okay. Holding costs are the costs incurred to store the inventory. Ordering costs, the cost related to preparation of a supply order, including the cost of placing an order, inspection costs, documentation costs, and others. Right? Okay, next, what is the pro and cons of holding inventory? What is the advantages of holding inventory? Okay, advantages of holding inventory. The need to meet the customer demand. Okay, taking advantage of bulk discount. Okay, bulk discount means we want to receive discount from our supplier. We need to purchase in bargain purchases. Okay, bulk purchases. So that's we can take advantage for that purchasing in bargain purchase or bulk or receiving bulk discount. Okay, reducing the total annual ordering cost. Okay, Next is disadvantage. What is the disadvantage of holding inventory? Means holding high level of inventory actually. Holding high level of inventory, higher storage costs. Okay, we need to maybe warehouse. We need warehouse to storage all the inventory. Maybe okay, not small one. Okay, the bigger one, because we need to maintain the level of inventory, the high level of inventory. Cost of capital tied off in inventory. Okay, so we need a cost to tie up the inventory, deterioration, obsolescence, and that this is the risk that we have to face because we hold the high level of inventory. Okay, maybe the inventory can absolutely can damage the inventory. Okay, or okay, maybe the inventory are outdated. All right. Okay, the next one, how to manage the receivable. What is the receivable? Is actually the apa ni, account receivable, the credit customer. This is receivable, credit customer. We sell something, we sell product, or we giving service to the customer, but the customer didn't pay yet. Okay, didn't pay us yet. So this is a receivable. So how to manage this receivable? How to manage this receivable? Okay, so this is the credit policy that we can apply to our credit customer. So we have a credit control, credit terms, and credit standard. Okay, what is a credit control? May be defined as minimizing the risk involved over goods of provision or service that third party on the strength a promise to receive payment from the third party at the sometime in the future. In a sense, credit control may be seen as a system used by business to ensure that it grants credit only to customers who are able to pay. So this is credit control. We only give credit facilities only for the uh, customer that were able to pay the debts. Okay, we are not giving the debts. We are not giving the credit facility, the credit terms of facility to the customer that will not able to pay us back. Okay, so this is credit control. The credit terms, how long that we give the period that the customer will pay back us. Maybe 1 month, 2 months. So this is credit term. How about the credit standard? Okay, the credit standard is the criteria to assess customer and determine the amount of credit and extent of credit period to be granted to debtors. Source of credit information about customer may be obtained from the internal and external sources. So this credit standard that we have to apply to all the credit customer. Okay, either to assess the customer and to determine the amount of credit that's suitable for that customer. This is the credit standard, and also to determine the credit terms that's suitable for that customer. All right. Okay. How many slides we have left? Okay, we have 5. Okay, this is the 5 of credits. Okay, 5 of credit policy. Okay, the first one is character. Okay, credit standard. Sorry, credit standard. Okay, the first one is character of our customer, the capacity, of the purchases. Okay, from the customer, the capital itself. Okay, and the collateral and the condition. Okay. Okay, this is delinquent credit accounts. Okay, how we can collect, or how we can collect our account receivable debts, okay, or our credit customer debt. Okay, the first one, the first one is letter of statement of account. We receive, we send to our credit customer, and then we make a phone call. Okay, then visit the customer premise. Okay, maybe they have a change already the telephone number. Okay, they don't receive the letter of statement, so we need to visit the customer premise. Maybe maybe the premises have been moved or not. Okay, and then if not successful, we sub to the collection agency. Okay, we sub to the collection agency to collect all the debts, and if not successful, okay, last step is legal proceeding, right? Okay, this is the last one actually. The last one for the management of current asset. This is the marketable security. Okay, maybe this is a new one for you. Okay, um, okay, for the marketable security, for others current asset item, that's cash, inventory, account receivable, is very familiar to you. But now the marketable security is not familiar. Okay, what is a family? What is familiar? What is the marketable security? Actually, the marketable security is the Malaysian government. Um, what is the marketable security? Okay, marketable security is actually the facilities that the government or uh, financial institution will give to company or to others, to individuals, to get this opportunity uh, for for financial fund. Okay, for additional fund for the business. Okay, so this is the types of marketable security: government debt security, negotiable certificates or deposit. We have a commercial paper, okay, repurchase agreements, and banker acceptance. Okay, so this is type of marketable security. Okay. Okay, my definition before that's for is actually for commercial paper. Commercial paper is granted from the financial institution to any companies or any businesses. Okay. And normally the commercial paper, or what the differences between commercial paper in bank loan? Okay, commercial paper is apa ni? Commercial paper, the interest rate is slightly lower compared to loan. Okay, commercial paper, because commercial paper only given to the client, that's the financial institution, um, what we call the that the quality client. Actually, quality client means that they had their will to pay back the debts. Okay. Okay, the every definition for each marketable security you can read. Okay, what is actually the government security? The Malaysian government raised short-term financing through the issue marketable debt instrument. The various form of government security that's available in Malaysia include Malaysian Government Security (MSG), the Malaysia Treasury Bill (MTB), and Government Investment Issue (GII). Okay, this is an example of government security. Alright. Repurchase agreement. Okay, bank sell market instrument to investor and buy back those instrument later. Okay, this is repurchase agreement. Okay, bank sells market instrument to investor and buy back later. That's why repurchase. Okay, negotiable certificate of deposit (NCD). Okay, a receipt certifying that money have been deposited in bank, issuing the certificate. Okay, this is NCD. Banker acceptance, short-term credit investment created by other firm and guaranteed by bank. Okay. Commercial paper, like I explained before, a short-term unsecured debts issued by firm. Why unsecured? Okay. We will explain in the next topic for financing current asset, what the difference between unsecured and secured debts. Okay. So that's all for today classes, for um today lesson. Okay, let's recap what we will cover for this topic. Okay, so actually we'll cover already what is working capital. Okay, what is net working capital, the working capital policy. Working capital policy, we have restricted working capital policy, we have relaxed and relaxed working capital policy, and we also have moderate. Okay, and describe motive for holding cash. So remember, we have precautionary motive, we have transaction motive, and we have speculative motive. Identify inventory management cost, why we have to manage our inventory. Okay, still remember what is EOQ, economic order quantity. Okay, account receivable management tools. Okay, how to manage our account receivable, 5 C's. Okay, credit policy, credit terms, that's related to account receivable management. Okay, and the last one is describe different type of short-term borrowing. Okay, short-term borrowing is actually we will cover in the next lesson for financing current asset. Okay, guys. Okay, so that's all. Thank you very much. Assalamualaikum.